Welcome back, savvy investors, ready to unlock stock market secrets and achieve financial freedom. Today, we're diving into Stephen M. Sears's game-changing book, The Indomitable Investor. We'll break down key takeaways focusing on the anatomy of information, navigating market cycles, and mastering financial statements. Whether you're seasoned or just starting, this video will equip you with the knowledge to make informed decisions. Get ready to take notes. This information can transform your investment journey. Let's dive in. The Indomitable Investor teaches that stock market success isn't about luck. It's about understanding the market and developing discipline. This book demystifies financial jargon and empowers you to make confident decisions. We'll translate key concepts into actionable steps you can implement right away. By embracing these principles, you'll build a resilient portfolio that can weather any storm. Stay tuned as we delve into understanding the anatomy of information. The market pulses with information. Understanding its flow and influence is key to success. News, data, rumors, and emotions shape investor sentiment and drive asset prices. Your goal is to identify reliable sources and filter out noise. In the age of instant news, misinformation spreads quickly, leading to impulsive reactions. Grasping the anatomy of information gives you an edge, allowing you to anticipate trends and make informed choices. Not all information is equal. In today's digital age, discerning credible sources is crucial. Question everything, and look for evidence-based reporting and independent analysis. Avoid sources that rely on sensationalism or unsubstantiated claims. Curate a portfolio of trusted sources that align with your investment philosophy. This balanced perspective will help you make informed decisions. Don't just skim the surface, dive deeper. Clickbait headlines can be misleading. Develop the habit of reading full articles and understanding the context. A single news story rarely tells the whole story. Look for corroborating evidence. Investigate reasons behind market events to make reasoned judgments. This critical approach helps you avoid falling prey to market noise. Information is raw material. It's up to you to refine it. Develop critical thinking skills to interpret and synthesize information. Question assumptions, identify biases, and look for patterns. A company's strong earnings report might seem like a buy signal, but dig deeper. This deeper interpretation allows for more nuanced and profitable decisions. The market dances to a cyclical rhythm of expansion and contraction. Understanding these cycles helps in making strategic decisions. Recognize where we are in the cycle to anticipate risks and opportunities. Bull markets can lead to overvaluation, while bear markets present buying opportunities. Respect the cycle's power and use it to your advantage. Market cycles are unpredictable. Focus on a strategy that adapts to different environments. Maintain a diversified portfolio to balance risk and reward. Stay disciplined with your investment plan to avoid impulsive decisions. Ground your approach in sound principles and a clear understanding of your risk tolerance. Each market cycle phase presents unique opportunities and challenges. During bull markets, stay disciplined and avoid overpaying for assets. Bear markets create opportunities to buy undervalued high-quality companies. Review your investment plan regularly to ensure it aligns with your goals. Stay calm and focused on your long-term strategy to benefit from market downturns. Investing is deeply human, influenced by emotions like fear and greed. Recognize psychological factors that affect your investment behavior. Develop strategies to mitigate emotional biases for more rational decisions. The market responds to supply and demand, not emotions. Rely on your predetermined strategy to avoid costly mistakes. The market is full of self-made pitfalls like herd mentality and overconfidence. Avoid following the crowd and making impulsive decisions. Question your assumptions and base decisions on solid data. Recognize biases like anchoring to outdated information. Seek a second opinion to gain a fresh perspective and avoid mistakes. Emotional discipline is crucial for an indomitable investor. Market volatility is inevitable. Stay calm and stick to your plan. Develop investment principles grounded in your goals and risk tolerance. Refer to your plan during turbulent times to avoid impulsive decisions. Maintain a long-term perspective to weather market storms and succeed. Financial statements are the language of business, revealing a company's health. Mastering financial statement analysis is essential for informed decisions. Examine balance sheets, income statements, and cash flow statements for clues. Uncover hidden strengths, weaknesses, and red flags. Practice and understanding will make financial statements powerful tools. Financial statement analysis is more than just numbers. It's about the story behind them. Understand trends driving revenue growth and expense management. Look beyond strong earnings to see if growth is sustainable. High debt might not be a red flag if managed well in certain industries. Context is key to getting the full picture of a company's performance. Section 3. Unveiling the hidden story. To truly understand a company's financial health, you need to connect the dots between different financial statements and look for trends over time. Don't just focus on a single quarter's results. Instead, look at the company's performance over several years to identify patterns and assess its long-term trajectory. This will give you a much clearer picture of the company's overall financial health and its ability to weather economic storms. For instance, a company might report a dip in profits for a particular quarter due to unforeseen circumstances like a natural disaster or a supply chain disruption. However, if the company has a strong track record of profitability and is taking steps to mitigate the impact of these events, it might still be a sound investment. Furthermore, it's essential to compare a company's financial performance to its industry peers. A company might appear to be doing well in isolation, but it might be lagging behind its competitors or facing challenges specific to its industry. By benchmarking against industry averages and analyzing competitors' financial statements, you can gain a more nuanced understanding of a company's competitive positioning and its potential for future growth. Section 4. Context is key. Remember, financial statements, while valuable, are only one piece of the puzzle. They provide a historical perspective and a snapshot of a company's financial position at a specific point in time. To make informed investment decisions, you need to consider other factors, such as the company's management team, its competitive landscape, industry trends, and the overall economic environment. Think of it like this. You wouldn't buy a house based solely on its blueprints, would you? You'd want to visit the property, inspect its condition, research the neighborhood, and consider your lifestyle needs. Similarly, investing requires a holistic approach. Use financial statements as a starting point for your research. But don't be afraid to dig deeper. Read industry reports, follow company news, and talk to analysts to gain a comprehensive understanding of the company and its prospects. The more information you gather and the better you understand the context, the better equipped you'll be to make sound investment decisions. Financial ratios are like X-rays for your investments, allowing you to peer beneath the surface and assess a company's financial health. These ratios, derived from a company's financial statements, provide valuable insights into its profitability, efficiency, debt levels, and overall financial stability. By comparing a company's ratios to industry benchmarks, historical trends, and its competitors, you can gain a deeper understanding of its strengths and weaknesses. Think of it like this. You wouldn't buy a car without checking its mileage, fuel efficiency, and safety ratings, would you? Similarly, financial ratios provide you with key performance indicators that can help you make more informed investment decisions. Just as a mechanic uses specialized tools to diagnose a car's engine, an indomitable investor uses financial ratios to dissect a company's financial performance. However, it's essential to remember that ratios are just tools, and their interpretation requires context. A single ratio in isolation might not tell you much. It's the combination of ratios and the trends over time that provide a more comprehensive picture of a company's financial health. Section 2. Profitability and efficiency ratios. Investors look at a company's profitability, its ability to generate profits. Key ratios include return on equity, or ROE. This measures how effectively a company uses shareholders' equity to generate profits. A higher ROE indicates better profitability and management efficiency. Profit margin. This shows how much profit a company makes for every dollar of revenue. A higher profit margin indicates better cost control. Efficiency ratios assess how well a company manages its assets. Key ratios include inventory turnover ratio. This measures how quickly a company sells its inventory. A higher ratio suggests efficient inventory management. Asset turnover ratio. This measures how effectively a company uses its assets to generate revenue. A higher ratio indicates greater efficiency in utilizing assets. Section 3. Debt and liquidity ratios. Debt is a double-edged sword. It can finance growth, but too much debt risks a company, especially during downturns. Investors use debt ratios to assess financial leverage and debt obligations. Debt-to-equity ratio measures debt versus equity financing. Higher ratios indicate higher leverage and risk. Interest coverage ratio measures the ability to meet interest payments. Higher ratios indicate better debt servicing ability. Liquidity ratios measure the ability to meet short-term obligations. Current ratio measures short-term liabilities coverage. A ratio of 2 or more is generally healthy. Quick ratio excludes inventory for a conservative liquidity measure. Inventory is harder to convert to cash quickly. Analyzing these ratios provides insights into financial risk and resilience. Compare ratios to industry peers and historical trends for context. Section 1. The Journey to Financial Mastery. Congratulations on taking this crucial step toward becoming an indomitable investor. Remember, investing is not a get-rich-quick scheme. It's a journey of continuous learning, adaptation, and disciplined decision-making. By embracing the principles we've discussed today, understanding the anatomy of information, navigating market cycles, mastering your emotions, and diligently analyzing financial statements, you'll be well equipped to navigate the complexities of the market and achieve your financial goals. Think of it like this. You wouldn't expect to run a marathon without proper training, would you? Investing requires the same level of preparation and dedication. By consistently honing your skills, staying informed, and seeking guidance when needed, you'll be well on your way to crossing the finish line and reaping the rewards of your efforts. Remember, the journey might have its ups and downs, but by staying focused on your long-term vision and adhering to the principles of sound investing, you can weather any storm and emerge financially stronger. Join the movement. Put your knowledge into action. Review your current investment portfolio. Are your investments aligned with your goals? Are you diversified across asset classes? Confident in the fundamentals of your investments? Commit to ongoing learning. Stay ahead of the curve. Seek guidance from experienced advisors. Join the community of investors. Share knowledge, learn from others, and create a brighter financial future. If you found this helpful, give a thumbs up, subscribe, and hit the notification bell. Until next time, happy investing.